Buying a car is one of, if not the most expensive mistakes I see people make. And it's not even because of the car, it's because they don't understand the process. So today I'm going to break down the entire car buying process step by step. We're going to explain how credit affects every decision, show you which banks to avoid, how to spot a bad deal, and how to walk away confidently when the dealership is pressuring you. And so whether you're buying new or used, leasing or financing, this video is gonna save you thousands. And so before we even get started, I really want you to know who I am and why I'm even qualified to talk about this, because this is not theory. This is years and years of experience. My name is Cody Kilday. I spent the last 7 years inside of the car industry, both working deals on the sales floor and seeing the financing behind the scenes. I've seen people walk in excited and leave locked into terrible loans. Not because they were dumb, just because no one ever explained the process to them. And today I run Signature Boost, a credit repair and funding company dedicated to helping over 1,500 active clients navigate the financial world and know the ropes before making big financial decisions, especially cars. Typically help first-time buyers, people rebuilding after credit mistakes, buyers who have been approved before but overpaid, and business owners who want leverage instead of desperation. And so I'm doing this video not only because people need new cars, but because people need better positioning before they even show up. And once you understand how banks, dealerships, and credit all coincide, the car buying experience changes entirely. And so step one, credit comes first. Before you even look at a car, credit decides everything. Interest rate, required money down, banks, if they will approve you or not approve you, and whether you get incentivized or whether you get punished. A 580 credit score and a 680 credit score can be the difference between 0 down and 3,000 down, 0% interest to 4% interest versus 18 to 29% interest, and prime banks versus predatory lenders. This is why I tell people, you are not shopping for a car. You are shopping for an approval. Here are some of the key factors that banks look at. Payment history. Depending on who the lender is and what industry they're in, they're gonna care about that type of payment history the most, i.e. mortgage to mortgage, car loan to car loan. So for this example, we're gonna be talking about car loans. They care about open collections or charge-offs. Do you have anybody that you still currently owe money to before you ask for new money? They care about credit utilization. Are you maxed out on all your credit cards and this is just another thing that you could potentially be late on at any time? This leads into our next point. Do you have any recent late payments, especially on an auto loan? And they care about the time between your last repo or your last bankruptcy if you have any. And so this comes down to one simple principle. If your credit is not clean and ready to be approved, you're not negotiating the approval. The bank is. And this is why preparing in advance and fixing your credit before seeking an approval changes the car buying experience entirely. This leads me into step two, banks you should avoid. This is where we're gonna highlight some banks that approve easily, but definitely cost you long-term. These are banks like Westlake, American Credit Acceptance, Santander, their subprime tier, Drive Time, Bridgecrest, Exeter, the list goes on. But why these are dangerous is they approve you at anywhere between a 20 to a 29% APR. And their loans are set up so that the majority of the interest ends up being paid up front, which can lead to those type of loans having either high repo rates or being impossible to refinance down the road. And some of those lenders even require a GPS or tracker be put in the car in case your payment's late. These banks don't care if the loan makes sense. They care if they can repo the car, which leads me to, again, another guiding principle of this whole thing. If a bank approves you easily with bad credit, you're paying for it somewhere. Let's hop to step three. Picking between a new or a used car. Before we even talk about money, let's decide what lane you're in. Let's talk about some new car pros. New cars typically come with factory incentives. They're eligible for lower interest rates because the car is brand new, so the bank feels safer. They come with a built-in warranty from the factory. Again, another reason why the bank feels safer. And you have better approval odds if your credit is decent for all the reasons I just previously listed. Hopping to used cars, those cars typically come with a lower purchase price. On top of that, you're not the one that's paying the majority of that off-the-lot depreciation hit. And most times you'll have more flexibility on model and selection because a used car lot's gonna have 20 different manufacturers on one lot versus a new car dealership, it's a Ford dealership or a Chevy dealership is only gonna have new Fords or new Chevys. How do you choose? Typically your credit score is going to decide what makes the most sense. So let's hop into the new cars. If you're buying a new car, you need to check rebates and incentives right off the bat. Never assume the dealership's gonna give you all the rebates. I've got some resources listed here that are great options for finding out what rebates exist on what vehicle you're interested in, whether the manufacturer website, Edmunds has a list, and Cars Direct Incentives has an entire list of them as well. What you're gonna be looking for are words like customer cash, loyalty rebates, if you're a military or first responder, or if they're occupation-based incentives, a college grad, financing versus leasing incentives, because sometimes those can vary between whether you're buying the car or whether you're leasing the car. Second thing you wanna do is find the true invoice price. MSRP and sticker price means nothing. I've got some invoice resources listed here, Edmunds, KBB, TrueCar, Cars.com. Why does this matter? Because the invoice tells you roughly what the dealer paid. Negotiations should start near invoice, not at MSRP. Tie back to what I mentioned earlier on variations between purchasing and leasing, let's explain the difference between the two. Leasing is not throwing money away if it's done correctly. And here's the situations where leasing makes sense. If you want a lower monthly car payment, typically it's going to be lower on a lease. If you like to get a new car every 2 to 3 years, or you drive under mileage limits. And if you want warranty coverage for the entire time that you have a vehicle, typically a 12, 24, or 36 months lease will keep you inside the bumper-to-bumper warranty period. Where can you find what lease deals exist on what cars? Those are best found on the manufacturer's lease pages, Edmunds, or Lease Hacker. Now on the flip side, when does purchasing make sense? If you plan to keep a car long-term, don't lease just to have to buy it out later. If you want equity or you drive a lot, leasing is not gonna make sense. In the situation of a lease, the bank owns the car and they have mileage restrictions. So if you go and blow through your entire lease's mileage in 1 year, you're gonna pay huge on the back end in penalties. Or if you plan to pay the car off early, definitely purchase first. Now, where can we find finance offers that make sense, like 0% or the 1 or 2.9% offers that you see online? Keep in mind, prime credit unlocks these opportunities. You can look to resources like the manufacturer's finance pages. Edmunds has a great finance deals section, and dealer websites verify independently, of course, but dealer websites will typically advertise their 0% or low interest rate offers. The 0%, 60, 72, and sometimes even 84-month offers typically beat just about any cash or rebate incentive from the dealership, but only if you're approved. Which leads me to my next point. If you're not going with a dealership incentivized rate, is to seek a pre-approval. A pre-approval puts you in control of the finance offer. You can get one at any of your local credit unions, a local bank, or even online lenders like Lightstream, PenFed, DCU, etc. Here's some of the benefits. You have complete rate transparency. All you're focused on is how much you're financing because you already know what your interest rate's going to be. You have payment clarity because again, once you're clear on what your terms of financing are, all you need to know is how much you're borrowing or how much you can borrow, and you'll know exactly what your payment is based on a simple calculation. The dealership loses leverage because they can't tell you that your payment's one thing and then change an interest rate later or have an out-the-door number be different than what you're expecting. And it's easier to walk away. If they can't meet your out-the-door requirements with either the lender or what you want to spend, sorry, no can do. This comes down to the principle that the dealership, if they want to compete for your financing, should be trying to beat your rate, not just simply determining it. This leads into the used car side. How to know if a used car is overpriced. Dealerships will typically price their cars based on retail value, which is what the car sells for on the market. On the flip side, lenders finance based on what's called a lender value or a wholesale value. This puts the bank in at least a little bit of a safer position in the event that they did have to take the car back and sell it at auction. And it's important that you understand the difference between the two. Here's some value tools. You want to go to KBB, NADA, Black Book, Edmunds, anywhere that can tell you what the car should be priced at on the market and what a bank is going to look at when they determine if you can finance or not. Here's the key differences. Retail value, what the dealership sells the car for. Lender value, what the bank thinks it's worth. And trade-in value, what you can get by selling it back to the dealership later on. If the dealership has the car priced at over retail value for one reason or another, expect a higher down payment requirement because the retail value is already going to be higher than the lending value that the bank thinks it's worth. Or flat out denial if your credit isn't in prime position because the loan is out of line. The car's not worth what the dealership says it's worth to the bank. Which leads me to my next point of understanding what's called loan to value. Loan to value sounds fancy. It's the loan amount divided by the car's value. And most banks will cap that number at anywhere between 90% and 120% depending on your credit. Here's an example. Let's say the car's value, not the price, the value of the car is $20,000. And the dealership has it priced at $26,000, plus you have to pay taxes and some of their dealer fees. That loan with no money down is going to be written at 140% LTV, which is a problem deal for the bank, which means that there's one of two solutions. Either the price on the car comes down to get in line with the bank's requirements, or you put up the difference in the form of money down. If you don't have a trade-in that's stacking on a bunch of negative equity from the previous loan, this can be an indication of one of two things. Either the dealership is in the car bad and they are trying to make up the difference by having you pay for it, money down, or they're just going for a home run and trying to make all the money. And so before you just say, oh yeah, I'm just gonna stack all my cash on the table to tell them exactly what I have, it's important you understand some key money down rules. First things first, if you have bad credit, the bank is going to want to be at a better loan to value, closer to that 90 to 80% range, in the event that they have to come and take the car. So if you have weaker credit, expect to have to put more cash down. This also goes into older cars. An older car is more likely to break down, which makes the bank nervous because in a situation where your car is in the shop with a $500 shop bill and your car payment's $500, odds are you're gonna pay the $500 to get your car back, or you're just gonna tell the bank to come get the car. So they want you to put more money down so that they're safer in the loan in the event that they have to come get it and sell it at auction. Which brings me back to what I was saying earlier. The third reason why you would be required to put more money down is if the car is overpriced. And in this situation, it is extremely important that you understand when it's time to walk away. Anytime you hear something like, this deal is only good today, another customer's on their way, the bank won't allow the changes, payment only conversations as opposed to what's your out the door price, give me a breakdown, and refusing to even show the approval terms, all red flags. My rule of thumb is pressure exists where the transparency doesn't. So let's say you make it past all that point, and now you're signing contracts. You are going to talk about gap and extended warranties. What are they? Why do they matter? And how do you buy them? Gap insurance pays off your loan in the event that your vehicle is totaled and insurance doesn't cover the remaining balance of the loan. For example, if you have a $40,000 car loan, you wreck your car, your insurance says it's worth $30,000, Gap pays that $10,000 difference to make sure that you're not making a car payment or that you just stopped making a car payment on a car that's not paid off yet, even though it's totaled. To a lot of people, Gap is important, but overpriced Gap is not. Here's how you check. Check with your auto insurance company. Some insurance companies will have you pay an additional part of your premium to make sure that in the event that the car is totaled, they guarantee that they will pay off the entire amount. If you're seeking a pre-approval and going through your own credit union or bank, sometimes the bank or your credit union will have their own Gap option, which will be cheaper than what's sold by the dealership. And there are other online Gap providers, or you can even check with the insurance or the warranty company that they are selling to see what an actual dead cost on it is. Because dealerships will typically charge anywhere between 2 and 3x above what the dead cost is on that Gap. Which leads me into my next point, that extended warranties can be smart if they're priced correctly. Extended warranties cover varying levels of mechanical failure on a vehicle in the event that the manufacturer's warranty is expired or that there was holes in the manufacturer warranty that this extended warranty supposedly covers. Here's how you can price check to see if you're actually going to get the return value out of what you're paying for. Almost all manufacturers will have some sort of backed warranty pricing that you can find online. And if they don't, there are other online warranty providers that allow either a month by month or just a flat out purchase price. And again, if you are seeking a pre-approval, which is why this can be so important, if you are seeking a pre-approval and have your own loan through your own credit union or bank, a lot of times they will have their own extended warranty options for that vehicle. If you're still not sure about it, just ask the finance person. Is this cancelable? Is it prorated? Can the bank finance it? And who's the warranty company? And you can check right then and there what the actual warranty cost on it is on the manufacturer website. And odds are you didn't know at least some of this information, if not the majority of it, because a lot of people walk around uninformed about what goes on a vehicle purchase. Every bad car deal starts with either bad credit or bad information. You are in control of that. So when your credit is optimized and you are well informed, you can choose the bank, you can choose the rate, you can reduce your own money down requirements, and you can avoid those 20 to 29% interest rate from the predatory lenders. So if you are planning to buy a car in the next 30 to 90 days, making sure that your personal profile is optimized for an approval can save you way more than negotiating ever will. And so if you need help making sure that you're in prime position or you're not confident that you're going to receive a good approval when you walk into the dealership, I've put links in bio on how to contact my team, along with all the information that we went over here, and I look forward to speaking with you soon. And for the rest of you, hope you enjoyed the information from an old car guy, and I'll see you in the next one.